This is an article I wrote in Over the Road magazine in April 2024. Who makes more money, the driver or an operator? A super highly contested topic such as earnings difference between driver or operator is eventually on the mind of every driver in trucking. Usually within a year or two of being a company driver, comparisons begin to formulate in their minds. Canada Revenue Agency does not separate drivers from operators, self-employed, officially, but their records do state that the reason is there is little to no significant difference. In my research for my 2025 book, Making Your Miles Count, Choosing a Trucking Company, I also found no statistically significant difference between the two categories unless one or two features were present. The first is, does the operator have their truck paid for? It didn't make any difference whether the data was from 1996 or 2012. The results remained the same. There was no significant taxable income differential until the major asset, truck, was paid for. Once paid for, either the lease payments were not there to reduce the income or the depreciation on the vehicle was minimal due to the time cost reduction in expenses. However, once the truck was paid for, the income dramatically increased from $20,000 to $30,000 on average. The return on investment of a paid-for truck is the first real value in the operator industry. Very few notable exceptions are available. The second feature that changes the earnings difference between company drivers and operators is in the application of non-taxable benefits to the taxable income. Using non-taxable benefits produces an approximate 75% reduction in income tax, $16,000 down to $4,000, or $12,000 to $12,500 of annual tax savings. So, if everything else remains the same, an operator has $12,000 higher after-tax cash flow than does a company driver. It has nothing to do with equipment or driving ability. It is simply an added tax advantage provided to an operator. That's the good news. The bad news is less than 3% of all operators in Canada use non-taxable benefits. If you're reading this and you submitted a TL2 simplified form to your accountant or provided him with the days on the road in Canada and the days on the road in the United States, you are not using non-taxable benefits. The Canadian tax laws do not allow you to use both the TL2 simplified form or figure and the non-taxable benefit figures at the same time. That's called double dipping. Well over 96% of all operators in Canada are asked by their tax preparers to use the TL2 simplified method to complete their returns. In 2007, when my first book was published, it presented the entire argument against using the TL2 in favor of the non-taxable benefit system. It's amazing that after 18 years, accountants all across Canada still do not know about it or do not care to save their clients the taxes. I'm sorry for being this harsh, but after 18 years, I've now assumed accountants will never use it unless operators demand it. Accountants refuse to invest time, effort, and research into the system because, quite frankly, to a tax preparer, the independent operator industry is low-paying freight. The industry isn't worth investing into, so they simply do what they have always done, the TL2 simplified method. Making Your Miles Count has kept track of our collective savings as of March 2024. It just passed $71 million in tax savings. The system does have serious disadvantages, especially to tax preparers. It's more detailed work monthly and requires a level of defense to CRA that is specific to the system itself. Linking the ELDs to non-taxable benefits is just the beginning. Collecting input tax credits from non-taxable benefits will also be a required defense. The list of details is actually quite lengthy for the tax preparer, but highly beneficial to the operator. It is my opinion that in order to adequately service the independent operator industry, technological innovation is an absolute necessity. Making Your Miles Count has invested in this specific technology now for well over 5 years, and it has simplified a very complex system into something the average operator and tax preparer can easily use and comply to. Making Your Miles Count guarantees the filing of non-taxable benefits to $50,000, something no other firm does. To me, it's a no-brainer. These are just a couple issues important to independent operator success. Our Making Your Miles Count podcast produces a wide range of different topics for the industry to consider. Me and my team have a booth at the Truck World 2024 event in Toronto, April 18th to 20th. Come on down, let's talk for a while. Contact our office and we can get you into the show with a free pass. If you can't make it, contact my office. I'd love to talk to you about creating after-tax wealth in your life and career. Okay, well, that is the article that I wrote, and it's actually quite controversial. Not necessarily from my position, but certainly for many people in the industry. If you bump it down the road and you're talking to operators or truck drivers, you have extremely strong opinions about this topic. Is it better to be a truck driver or an owner-operator? The advantages and disadvantages of being an operator go up and down considerably, sometimes as the market goes up and down. It can, should I say. Remember that there are two different types of operators. There's a lease operator and an owner-operator. And a lease operator is the guys who get paid cents per mile, and an owner-operator gets paid percentage. And those are two completely different business models and different mindsets, and actually different results financially as well. And in really good times, it's probably better to run percentage, but when the freight rates are down in the toilet, it's probably better to run cents per mile. At least in some instances, in some cases, or not some, but in a general state. Because generally, when it comes to if you're running cents per mile, you don't have to worry about good paying freight, or should I say horrible paying freight, deadhead miles, that kind of thing. And it makes it much easier for you to manage your cash flow, because all you're thinking about is miles, miles, miles. Now, a company driver, generally speaking, on average, gets between $4,500 and $5,000 of after-tax money that is available for them to live and survive on. There are exceptions. It has been in certain areas it can creep up a little bit, but generally long distance over the road individuals, that will be considered national averages. The taxable income for that particular net income would be somewhere around the $65,000, maybe not 70, but close to 70. Depends on your net claim code, how many kids you have, that kind of thing. There's a lot of other factors that have to do with income tax that would affect your net income that way. But you're looking at let's say $5,000 of positive cash flow if you're a company driver. Now, the difficulty is trying to estimate or calculate what is the positive cash flow for an operator. If you look at an operator's paycheck and you realize that they get $6,000 or $8,000 deposited into their bank account every 2 weeks, your first knee-jerk reaction is, well, of course, $12,000 to $14,000 versus $5,000. Well, that is not net income. That is gross income. Off of there, you have to take possibly the truck payment and maintenance on there, and business expenses and the like. Now, if you're an owner operator and you are not using non-taxable benefits, generally speaking, after all of your expense, you may get say $14,000 deposited into your account, but You take all of your expenses off there, and you're going to be left with about $5,000. Now, it's almost impossible to look at it on a short-term basis, like say 3 months or something like that, or even 6 months, and say, hell no, I got way better cash flow than that. You have to take a look at what your net income is after your taxes, and when you're a corporation, which I recommend people doing, or from that case, even if you are self-employed, you have to consider what you're paying for your taxes at the end. And when you take all of your cash flow less your taxes, it's going to range right around that $5,000 mark, because there's very little difference between a driver and an owner-operator. And like I said, if all of a sudden you don't have a truck payment anymore, and you get an extra $2,000, $3,000, $4,000 or something like that in a month, can you immediately tell, like, oh my goodness, if you have a $3,500 truck payment, you got $40,000 of positive cash flow. And oftentimes people say, they start panicking, and they say, goodness sakes, $40,000 more, I'm going to have huge tax bill. And so they immediately think spend money. Don't do it, because that is a trap. What you want to do is be able to pull money out of your corporation, if you're a corporation, and not pay taxes on it. And realistically, there's only one way to do it, and that is non-taxable benefits, either through non-taxable benefits per diem in terms of your meal allowance, and or personal vehicle log, using a personal vehicle for your business. That is the number one best way to pull money out of your corporation. If you have an accountant who says, hey, you know what, you want to save money, you want to go and declare corporate taxes, and then you only have to pay corporate taxes, and that's it. I'm calling really big BS on that. There is no income tax savings if you go the route of earning like say $60,000 in a T4, or earnings at $60,000 in dividends, because you're going to need to have it as dividends to take it out of the corporation. So let's review this a little bit. If you have a corporation and you don't want to take it out as a T4 income and pay source deductions on it, you will have to pay what's called corporate taxes. And that's generally, it ranges between 9 and 13%, depending on which province you are, but it's about 10%. And everybody goes, 10%, and it's flat rate fee till up to $500,000. So why in the world would you do anything else other than keeping corporate income in there and pay corporate taxes? Here's the problem, and that is the money has to absolutely and completely stay in the corporation. What are you going to live on? How are you going to pay your mortgage, your car payment, your groceries, your hydro bill? Because all of the income stays in the corporation. You cannot take that money out. You can take it. You cannot without paying taxes. Make a correction on that. The cheapest way to take it out once it's declared as income, a corporate income, is through what's called dividends. Or dividend taxes, and you'd have to pay dividend taxes on the dividends. I'm getting my words all mixed up. Okay, but realistically, what you're doing is you're comparing T4 income with source deductions and income tax on there, and not source deductions, but you have corporate taxes and dividend taxes. So when your corporation declares an income, you have two methods of getting it. You have two taxes: corporate taxes and dividend taxes. When you take everything all out, so your corporation has zero income, and you can go out and buy hats with it because it's personal money. If it's on a T4, then you just pay income tax on it, with the exception of Canada Pension Plan. The only savings between the two situations, the only saving is actually Canada Pension Plan. But the bottom line, I don't want to complicate it too much, but the bottom line is you never declare corporate income and therefore having to force you to later on pay dividend tax. You never do that unless your T4 income is more than $65,000. Because as soon as you get above that $65,000, the tax rate that you're paying on every additional amount above $65,000 is more than if you would pay both the corporate tax and the dividend tax. So if you're making $100,000 of taxable income in a year, well, take $60,000 or $65,000 in T4, and the balance you declare as corporate income, and then you turn around and declare a dividend, and you only pay the corporate tax and dividend tax at a flat rate fee. And if you make $300,000, the rules are still the same: $65,000 as the T4, and then the balance as corporate income and dividend taxes you have to pay on that on dividends. It's actually a very simple basis. Now, the reason we do this is so that you gain the benefit of Canada Pension Plan, because the tax rate is actually almost identical. If your corporation pays $10,000, or let's say you make $60,000, so you're paying $6,000 in corporate income, okay, on that $60,000. You're paying $6,000 to Canada Revenue Agency for your corporate taxes. Then you turn around and you pay dividend taxes. Now, you don't get any benefit whatsoever from that $6,000 you sent for corporate taxes. Zero. But if you declare it as T4 income, then at least you got Canada Pension Plan that you've just put yourself into. Now, I'm not a huge fan of Canada Pension Plan, whether you're going to make a giant it's not going to make you wealthy, but it does bring you some benefit, and if you die beforehand, your spouse gets some sort of benefit still from it. So it's better to get something from Canada Pension Plan than it is nothing from a corporate income and dividend taxes eventually. So realistically, that's the two things. I'm a little bit off topic comparing company driver versus owner operator, but there's a big factor in when it comes to taxes. Taxes is probably the major factor, because very, very few individuals actually end up owning their own truck. You pretty much have to be in the industry for 25, 30 plus years, and you have to have your mindset right from the beginning that your goal is to own that truck or any truck free and clear. And that requires a great deal of discipline and structure, understanding not just what shape your truck is in, but also how to operate with first of all non-taxable benefits, because that's a huge benefit for truck drivers. That's a big factor for it. Now, I was just in a meeting a little while ago about an individual who bought a brand new truck with very little down on it, and he had lease payments, I think, out to 7 years or something like that. And unfortunately, at least in my opinion, the individual didn't really think through all of the full implications of owning a highway tractor and its impact on their goals and the like. Okay, for instance, their payments were, I think, $4,500 or something like that. And the full impact really is, if you take a brand new truck and you drive it for 1 year, you're going to get generally speaking, on average, you're going to get a little bit of extra cash flow because of it. And it's going to look pretty good, generally speaking. And it's actually, you look at it for the first year and you go, oh man, it's not too bad. You got positive cash flow, you meet all your payments, you just make sure you do your miles, and everything is fine. But remember, the first year of operation for that truck, you don't have much maintenance at all. Your maintenance doesn't actually come in until 2.5, 3.5 years into it. Probably 2.5 years into it, you're first starting with tires, so you're looking at $6,000. And if you don't manage your money for the first 2 years, if everything that comes in goes out and you spend it, pay taxes on it, and so be it, you're going to be in trouble in 2, 3, for sure for the 4th year, because you don't have any money for some bigger bills. And now your truck is 2 or 3 years old, and it's not on warranty anymore, or it's starting to wear out. The stuff that is wearing out is not on warranty, and you have higher expenses. And if your truck payment is like this guy's was, $4,500 all the way through to 6 or 7 years, whatever it was, it's going to get tighter and tighter and tighter and tighter. And generally speaking, if the crisis in that business model comes right around the 4th year, 3.5 to 4.5 years, and panic, if you haven't prepared yourself, panic generally sets in. And that's where the average driver says, okay, now I'm in big trouble. What do I do? This truck is, quote unquote, falling apart. Well, it's not really falling apart. It has natural maintenance on there, but you haven't saved up for it. So then the mindset is, well, I can't afford this anymore. I can't do it. My life is so tight that I can't afford to maintain this truck. The knee-jerk reaction then is, well, I got to trade this in. It's already 4 years old. I got to get out of it, see if I can do it. And so they go back to the financing company, and they will say, oh, you want to trade it in? By all means, sure. Like, come on in. Now, the problem is, if you have little money down right up front, you're at the 4-year rate. Let's say it's 6 years. You're at the 4-year mark. There's no equity in the truck. And if it's a lease, you have to pay the lease right to the end. On a really good situation, you might have par, and you might be underwater with it as well. So you don't know, because your truck could be a lemon, or the entire market may be upside down. So you have to see where you are going to be in 4-6 years from now, and you have to prepare for it. I'm an advocate. If you're going to go little to no money down, and you're going to go out for 6 years, I would highly recommend that you do exceptionally high truck payments for the first year, and then slowly go down over the years, so that you have a little bit more leeway. That really technically doesn't solve a problem too much, but it has at least some sort of an impact. Gives you a higher probability of success in the end. But financing companies are generally not interested in doing that. The primary reason is that they make money while you are in debt. They do not make money when you are debt-free. Leases, you pay interest on your lease right to the end, even if you trade it in. And that's where financing companies make the most amount of money, is in leases. And that's why salesmen push leases way more than financing, because they make sometimes triple the amount of commission when they do leases rather than owning. I have a great podcast. It's animated. There are a few things. Look it up. Owning versus leasing on our podcast site. It's a great great podcast. Lots of individuals have saved themselves an awful lot of headaches. They could save themselves 10 years worth of headaches if they just think through what they're doing initially. So that is a pretty major issue with when it comes to being successful as an operator versus a driver. There are some individuals who are passionately independent and they really love the idea of owning their own truck or managing their own truck. If they can think through just some of the small things, even if a person gets themselves into a truck that is a lease situation, low money down, that kind of thing, the tax savings that you do get from non-taxable benefits makes a very significant difference, because you're talking $48,000 to $50,000 or more in a 4-year period. Well, if you would just take this tax savings that you got, put it into a savings account, that's all you did, and in that situation, by the time it starts breaking down, well, you have $50,000, and that will help you to get through to the end of your lease. But like I said, the vast majority of operators out there, they don't use non-taxable benefits. And we got some good podcasts on non-taxable benefits. I've been writing about non-taxable benefits for, what is it now, since 2008. I've been writing about it in Over the Road magazine. And the problem is accountants just don't pick up on it. And they the vast majority, 99% of it, look, you are low-paying freight if you're an owner-operator, and they don't want to do the investment into it, and if they'll do it, maybe, I don't know, I only know a couple of them that are doing it, and they're either not doing it well or they're not doing it very much at all. That realistically, the ones that are doing it, they don't stand behind the savings, and it's a huge savings. You're talking $12,000 a year, and that $12,000. I mean, Canada Revenue Agency takes one look at that and they salivate and they say, hey, if we can reverse this, hey, that's $12,000. That's not a bad savings in my audit book that I have. If they can, they will, and it's not that they cheat, but there's so many detailed rules with regards to non-taxable benefits that it's actually easy to overturn. We've been doing it for, like I said, for almost 20 years to 18 years or so, and realistically, the rules that we complied to 5 years ago, they just get tighter and tighter and tighter. And the only way to really tackle the non-taxable benefit issue with Canada Revenue Agency, you got to do it by software. And you just have to comply to the software, make it as simple as you possibly can, and then we can do it. But without software, I would never be doing it without software. Not just because it's more work, but because it's basically almost impossible to defend to Canada Revenue Agency on more than one or two small clients or something like that. But then what am I going to do for a living, right? You got to have a certain amount of volume in order for it to make a living and do it. And that's the other problem too. Accountants just do not focus on the trucking industry. And it's my passion. It's what I love. Like we said, $71 million we've saved since 2006. That's when we started keeping track of the tax savings for our operators. And it's actually a very simple formula that we put into our database, and we track it almost on a daily basis. It goes up a little bit. I think this is in. I'm recording this end of November, early December, This article was for April, and I mentioned $71 million. I think we're at $76 million. So we're getting $6, $7, $8 million a year in tax savings for our clients, and that thrills me. That's what gets me up in the morning. I love the idea of not just saving taxes, but changing people's lives because you're saving taxes. We've had I'll tell you where the biggest tax savings comes is when you have a husband and wife both driving. When they're both driving, that means they're both saving $12,000 in taxes. So if it's whether they're super single or whether they're running full bore on their, imagine saving $28,000 a year in taxes. It does not take very long to make major impact on your after-tax wealth. We've had several clients that have been with us for 10 years or more, and their numbers are in excess of $250,000 in taxes. I think one even has $300,000 in taxes or something like that, which means they drive a fair bit, but they also they both utilize that $300,000 in 10 years. That's unbelievable tax savings, and it's legal, and it's moral, ethical, the whole thing. But it is technical. That's the only drawback of it. Is technical, and we train people basically one by one to comply to the system, and we're trying to implement non-taxable benefits in the owner-operator industry, coast to coast. We do have clients. Basically Prince Edward to Vancouver Island, but they're speckled out quite a bit. And what we really want to do is create an awareness all across Canada of the services. Most everything is all done digitally, online, and we teach online, we show online, and we walk people through the training process and the savings process. And you can see sometimes on a monthly basis all the tax savings that you have. It's quite remarkable. That's why I'm even in this industry. There's lots of other things I could do, but I really enjoy. I really enjoy tax savings. That's quite a bit. There is no other gimmick. There is nothing else out there like non-taxable benefits. There is no. I guess you would call it a hack, but I hate the idea of hacks. People saying, I'm going to you just do this, a hack, and voila, you're a millionaire. No. This is a tweak of a very significant portion, and you are able to save massive amounts of tax money. Some of the disadvantages are out there. For instance, if in some financial industry, like banks and some credit unions, not all, they don't know how to take a look at the $35,000-$40,000 worth of non-taxable benefits that you collect, but you don't report on your personal income tax. So if you're trying to buy a house, how in the world do you do that when you show basically, say $20,000 or $25,000 a year in income? Before, you used to show $65,000, $70,000 worth of income, and now you only do 25. And the poor banker says, "Oh, you poor guy." But you have higher than before cash flow at the same time, and so you have it because you have an extra, $12,000 a year. But the banker doesn't see things because they don't know how to put that non-taxable benefits in the loan little field where they say what your income is. Credit unions are better at it than chartered banks in Canada, but certainly you have to explain it. It can be done. It has to be explained. There are some credit unions, for instance, who have reprogrammed their loans officers' screens there, and they say, is there a field in there for non-taxable benefits? And they can plop that in there, and bang, you're doing awesome. So realistically, it makes some things difficult, But the only reason why it is difficult, or it appears to be difficult, is because it works so well. That's the most amazing thing. And hey, you know what? I would rather work around other issues and not pay taxes nearly as much, rather than having high taxes and be able to borrow all through your future. Now, if there's an individual who's saying, "Look, I want to buy a house." Well, how in the world are you going to buy a house? Realistically, you have to save up a down payment, and you have to have the right credit rating, and you save up a down payment, and then you have to have the income to support that. Now, let's just use this as an example. If an individual is able to save an extra $12,000 a year for 5 years, you're talking what is it? 12 times. I'm supposed to be the mathematician here, or the accountant. But if you do 12,000 years for 5 years, 12,000, 120, 60. That's $60,000 a year, or $60,000 in 5 years. Sorry, goodness sakes, $60,000. Now that's a pretty fair dent in a down payment. And realistically, you haven't changed anything from what you're doing. You're an owner-operator before, and you're an owner-operator now. All you've done is saved $12,000 a year in taxes. And so you have an extra $60,000. Well, even if your T4s is $20,000 a year, you could think ahead and say, okay, for 5 years, I'm going to use non-taxable benefits. Then, if you want, you can have your corporation give yourself bonuses or whatever it is, and you suddenly have a T4 earnings of back up to $65,000, $70,000 again. Well, now you do have a losses for, say, 3 years in your corporation, say $30,000, $40,000. So you got maybe $100,000 worth of losses after 3 years. Sounds terrible, but it's on the books. You haven't really lost anything, but on your personal T1, you're back up to $65,000, $70,000 in income again. Then you make an application, and then you should be able to get you should be able to get a house with that level of income again. And then once you have the house, well, then you start going back into you put your salary extremely low, and you just draw money out of the company because the company owes you money at that point. Now there's different ways to do it. So it would basically take you about 8 years to significantly come up with a good down payment, and you'll be able to buy a house in 8 years. And that's when you're starting from scratch. And realistically, it can be done, but it gets a little bit more tricky when you're thinking. You have to. It gets a little tricky unless you think ahead and you say, this is the plan that I have. Now, there's various options with which you do it. But if you start out with zero money in your pocket and you say, I want to buy a house in 3 years, it's really rather, I'm going to say the word foolish, to think that you can buy a house in 3 years, even if you're a T4 driver. Well, how are you going to come up with a down payment? You haven't had anything right from the start. And how much can you actually save in 3 years? Well, I can save $10,000, $15,000. Well, that's a phenomenally low down payment. Now you're looking at a whole bunch of other financing issues for a house. Can you even buy a house with $10,000, $15,000 down? Yes, but what are your actual circumstances on there? You are way behind. The goal is not to own a house. The goal is to own a house free and clear of any debt. What's the fastest way to do that? And it's almost always delayed gratification, which basically means you discipline yourself for a number of years first. Then you make the commitment when the ground is solid beneath you, and then you then you accelerate so that you can pay down your mortgage even faster than what is normal. 15 years. You should not have a house mortgage more than 15 years. In Canada, you're almost talking in Greek hieroglyphics. Nobody understands 15-year mortgage. But so maybe if you have a 2025, but make extra payments whenever you can, and try and pay it down in 15. In the end, your goal, without a goal, people, they just carelessly do things. They do things spontaneously and blow money and stuff like this. And I guess maybe I'm a little bit of a bizarre guy. I'm a very goal-oriented person, and it's not maybe as bad as my dad, where he would go from A to B or A to D, and then as he was going through, once he got to his destination, then he'd stop and celebrate a little bit, and then go back and pick up all the dead bodies that he had from going from A to D. Now, sacrifice is as a part of life. If you don't have it implemented in your life, if delayed gratification is not deeply ingrained in your life in some way, you run the risk of losing everything, because there are far too many trick ups, far too many minefields financially in our lives that we walk across. And delayed gratification, there's many things that I could buy right now that just because I even have cash for it, but and we may even need it, but realistically I always practice delayed gratification. Say, you know what, I could buy it, but I don't want to buy anything very significant on a like a whole bunch of times, like all at a time. Like buy 6 or 7 major things in a month or two. You gotta pace out the things that you buy. Just because what is that where you buy something and not the warranty wears out, but your excitement for owning it wears out, and that it could take a week. It could take 2 weeks or a month or something like that, and you say, okay, it was new, but it's not as exciting as before. It's normal. You have to wait until all of that goes through your body, so you don't your mind, so you're much more level-headed in it. If you keep going from one high to another purchase high to another purchase high, all you're living on is highs, and you very simply will become bankrupt very quickly, because you just end up spending way faster than you're able to earn. And so delayed gratification is an absolute necessity in life. Now, I've seen a lot of very, very frugal people, and there's some people that, in my opinion, are much more frugal than even I am. Like, there's many times I could buy a brand new vehicle just because I have some cash set aside. My wife and I, we don't have any kids anymore. That's why we have cash. If you have kids at home, probably you don't have cash. But once our kids left our home, both my wife and I are actually quite frugal, and we don't like the highs of purchasing something. Generally speaking, I've never even bought a brand new vehicle. I've never even test drove a brand new vehicle, and yet I could buy a brand new vehicle if I want, for both my wife and myself. Maybe not. We don't have cash for both of them, but even for one, I could if I want to, but I don't like spending that money. That a personal vehicle is an extremely highly depreciating vehicle, and I generally buy a 3 to 5 or 8-year-old vehicle, and so that the vast majority of the depreciation is down. I try and get a good deal on it, because I'm not in any kind of rush to buy a vehicle, and I get a good deal on it, and I can hold on to that thing for 5, 6, 7, 10 years or whatever, and it hardly goes down in value. And we're okay with it. I don't need a brand new vehicle in there. But everybody has their own vices, I guess, and realistically, owning a home, in my opinion, in the trucking industry, I would probably say one of the fastest ways to do it is become an operator, especially if it's husband and wife. Husband and wife, can you imagine two individuals who have their mindset, we're going to drive truck for 5 years, and we're going to do non-taxable benefits, and because we're an owner-operator, he's maybe a little bit of a mechanic or whatever. Even if they buy a brand new truck, or very close to a brand new truck, and the cash flow is just par. Okay. Now, if you're driving team, generally speaking, you should have no problem with cash flow because the volume, generally speaking, is going to be higher than the needs on it. So, but if all you do is just put aside $24,000 a year because of your non-taxable benefits savings, you do that for 5 years, you got $125,000 in savings, and that's making savings is making earnings. If you're putting it in, say, mutual funds or something like that, waiting for you to buy a house, well, 5 years goes by quite quickly, and if you can have a major down payment on a house, and all it takes is 5 years of your life, that's pretty significant. And I think that's probably one of the easiest ways to get into a house. It's just a 5 year sacrifice. Now, that is that's pretty much working with debt. And the closer you get to retirement, your mind starts thinking differently. A lot of truck drivers are 45, 50 years of age, and they're getting closer to retirement. When your kids are out of the house, let's say you're 45 years of age, generally speaking, at that point, maybe not 45, but maybe 50, your kids are out of the house, or hopefully, anyway. Let's use that as an example. And you both the husband and wife both go out on the road. Even if the wife, for instance, had a job that was making, say, $50,000 a year, it's $50,000 a year less the taxation on there. The biggest thing, if you're both out on the road and you're both collecting non-taxable benefits, you're going to save $25,000 a year, without a doubt. But if one of you is driving and one of you is earning, the actual person making $50,000 a year, the net isn't actually all that much. So about $3,000. Well, maybe they pay for rent and stuff like this, but realistically, if you wanna catapult your after-tax savings, it's best for both people to drive. So if you're in a situation where you can actually both drive, then that produces phenomenal after-tax savings. You can cap up your TFSA very quickly. It could take you just a few years to get a couple $100,000 into a TFSA. You could cap out your RSPs and have even more tax savings because of RSPs. Or you could just save money on the side. Probably the biggest one is TFSAs. Those kind of plans, so you say, okay, you're 50, 55 years of age, you got 10 years before you retire. The best way to do it is, if you can drive 5 or 10 years out on the road, you have everything you need now to retire at 65. That's maybe a really aggressive, but I do know, I bet you I have about 8 or 10, maybe 12 people who they're empty nesters and they decided to just drive out on the road together. That produces such after-tax wealth. You can build money so quickly doing that. It is truly startling. And there's a movement for individuals who say, listen, we raised our kids and we never put anything aside for retirement, and our house is three quarters paid for, and got a quarter left. If they both go out on the road and they're both and they're operators and they're collecting non-taxable benefits, realistically, they should within 5 years have their TFSAs capped out if they had nothing in there, and their house is paid for, and well on their way to do it. Is it a sacrifice? Yes, it is a sacrifice. But imagine how much better you feel when you're looking at capped out TFSAs and maybe some RSPs and a paid for house. Your life is very, very different. We've oftentimes had our podcast with Dan and Peter, and they're both at that retirement age, very close, and their houses are either completely paid for or very, very close to being paid for. You think differently. Your life isn't as pressured as before, and there's more and more people saying, you know what, if I really want a respectable, I want a secure retirement, let's both jump out on the road and drive for X amount of years until we get to this goal, and then start enjoying your life. Not all our goals in life are money, but it sure makes a difference when you're 65, 70 years of age, and you got that extra $200,000 in TFSAs or RSPs or something like that. It makes a big difference. But anyway, that's pretty much it. The difference between driver and operator, and that's a pretty major difference. Those two differences: you have to have your truck paid for, and non-taxable benefits. Other than that, have a good trip, and we'll see you next podcast.